You can only find the number of stocks is right for you over time. It's like the sleep test where you think, oh, if you wake up in the night and you're thinking, I've got too few stocks, I'm heavily concentrated. If that's worrying you, you need more stocks, you need to diversify. But you're right, Mark, it's dependent on your own circumstances, your own experience. And if they all go to zero, can you survive financially? If so, yes, then just have a handful of stocks, maybe.
And potentially the other mistake people make is they have a very diversified oil and gas portfolio or a very diversified banking portfolio. It's understanding those risks and how they correlated in your portfolio as well, I think.
The other thing that's worth thinking about is how much cash you hold. So I used to be very concentrated, but held a lot of cash as well, ready to deploy into stuff. Mark doesn't tend to hold much cash, but
yeah, zero is my aim of my portfolio.
That's
I don't tend to hold a huge amount of cash, although I do have more than usual at the moment. But yeah, I tend to aim to be mostly fully invested.
Hello, and welcome to the Investors Roundtable, a four-way discussion where Roland Head, Mark Simpson, Bruce Packard, and Maynard Paton talk about their shares, portfolios, and the markets. Roland seeks reliable dividends. Mark prefers deep value. Bruce likes quality compounders, while I look for owner management. This time we cover house builder Bellway, wiring specialist Luceco, and fashion retailer Superdry. Let's get started. Roland, you and I talked about Bellway in the last Private Investors podcast. Can you recap why you bought the shares back in October? Then I'll ask Mark and Bruce for their opinions.
So Bellway is a FTSE 250 house builder that has been in business since 1946. I bought the shares back in October at about £18 for two reasons, really. I think at a sector level, house builder shares had sold off quite hard at that time. I think Bellway was down about 40% at that point in the year. And I think the fear factor about higher interest rates was really starting to kick in, and many of the big house builders were trading at a decent discount to their net asset value. Although I could see quite a lot of the downside risk in the housing market was maybe still ahead, I thought that a fair amount of this bad news was already priced in, probably. So I thought house builders generally were starting to look cheap, assuming we aren't headed for a rerun of 2008, which obviously I don't think we are. I chose Bellway specifically because it ticked more quality boxes for me in addition to looking cheap. For example, unlike many of its rivals, Bellway survived the 2008 crash without needing to raise equity and without suspending its dividend. Although the payout was cut, payments continued without a break. I thought this suggested a more conservative corporate culture with a focus on managing activity and returns through the cycle. In terms of profitability, Bellway's operating margin and return on capital employed have averaged about 15% since 2009, I think. And my sums suggest the stock's delivered an annualized total return of about 10% per year over the last decade. Although I admit there have been some exceptional tailwinds for house builders over the last 10 years, I think structural demand for new housing in the UK is likely to be strong. And I don't really see any reason why Bellway can't continue to generate decent returns over the next cycle. I think, or I hope, the price I paid already factors in a reasonable margin of safety, even if things do get worse.
Mark, what do you think of house builders and Bellway?
It's interesting, isn't it? Because it's been one of the cheapest sectors for quite a while, and everybody's been anticipating weaker house prices, weaker transactions, and they have been to some extent. It's a big debate. Is this now the bottom? Is the economy looking up? It's one of those where I'm not sure I know. I think on a balance of probabilities, I'd say that you will do okay owning a house builder at this point in the cycle, but you need that very long-term view. Bellway doesn't stand out to me. I think if this was something I wanted to play, I think I'd be tempted with a sector ETF or something that bought the whole of the house building sector, because sort of Bellway doesn't stand out as maybe the biggest with economies of scale. It's not necessarily the highest dividend paying. It's not necessarily the cheapest on earnings. It's not the cheapest on price to book. So I guess that's my hesitation with something like Bellway. I think you said that this is a potentially deep value play. And I think maybe Crest Nicholson, I don't own any, but that if you want the deep value play, they're on the lowest price to tangible book value. Yeah, but even then, I'm not sure I'm tempted to buy that just for that price to book value. I think I'd be tempted to buy a sector ETF. So What's your thoughts on that, Roland? Why would you go buy one house builder with the sort of risk associated rather than just buying a cheap sector?
I don't tend to buy ETFs, although I take your point about the idea of buying a basket of shares. I think there's plenty of logic to that. But Bellway, I think in particular, rightly or wrongly, over a longer period of time, say 10, 20 years, returns from the business and the general stability of it had been superior to some of the other companies that have had some near-death experiences really during the financial crisis. And Bellway avoided all of that. It wasn't purely a deep value play. I think looking back over the history, there was more evidence of quality as well. And that combined with the valuation was what appealed to me. I'm not really looking to flip it out quickly. I hope to keep holding the shares for a while, as long as they do provide cash returns in the future. So yeah, it was a decision at the time. And I certainly agree there's more than one way to play the housing market at the moment.
So you said you bought at £18, and looking at the chart, that's a pretty good price. It's now approaching £23.
Yeah.
So that's up sort of 27% in 6 months or so. Would you be a buyer today? Are you thinking when some of those dividends come in, I'm going to keep buying this at 23, 24, 25, 26 pounds? Or is this a sort of, you like it because you got in cheap and it's done the business for you?
Yeah, there's an element of that. I wouldn't be rushing to buy much more at the moment. I think the net asset value was about £28 a share in the last account. So the shares are still at a discount, but I was happier with the valuation when I bought it. And I'm probably not rushing to buy more right now. If it got a bit closer to £20, then I probably would be tempted.
Bruce, what are your thoughts on Bellway?
What I wanted to ask is the margin of safety you mentioned, because I think you're mad, because I looked at this in the financial crisis and revenues halved. And I think the thing people get wrong about the house builders is in some ways this is going to be worse than the financial crisis for the house builders, because what happened in the financial crisis, there's a credit crunch, Bank of England cuts rates, and a lot of businesses were effectively bailed out. What I think is going to happen is the Bank of England is going to keep raising rates until stuff breaks, but they're not cutting rates anywhere near as aggressively because core inflation's high, food prices are high, they've been heavily criticised. So I think the interest rate environment is going to be considerably less benign this time round. And I just wondered about your stress testing when you say margin of safety. What sort of downside scenarios have you factored in?
I suppose in some ways I agree to an extent that the risk is there'll be a period where it's quite difficult to sell houses at all because of the mismatch between pricing and the cost of borrowing. And that's probably, in some ways, I would say that's probably the biggest risk or the biggest concern for me, that volumes will dry up and it will be a while until the market finds a new balance. And obviously also over the last decade, we've had so much easy money to support house prices. So the whole process of price discovery and the risk of the market really slowing down is what worries me more. But again, this is a company, and like most of the other big builders, but certainly this one has operated through many periods of higher interest rates in the past, and it's not a completely unprecedented situation. It's just something that we haven't seen for a while. With a, say, 20 to 25% discount to net asset value, I think there is a bit of a margin of safety there. Balance sheets are in reasonably good health, so it's not a case of going into this situation with too much leverage. So I'm willing to wait and see how things pan out and revise my position if I think things have changed or if things seem to be different to what I expected. But I don't see any fundamental reason why houses won't be built and sold profitably over the next decade. And I think Bellway has as good a chance or a better chance as anyone else of being able to achieve that.
I think the margin of safety is in the book value, isn't it? So even if revenues do halve because there are fewer volumes, you've still got this land and the capitalized value of the half-built sites on the balance sheet, and they will sell at some point. They will have a cash value to someone.
So what portion is the land of that tangible book value? Because in some ways, the land is only worth what you can build a house and sell it profitably for. So if we see, say, 15, 20% house price falls, you could see the land value go down by 40, 50%.
Well, it's worth looking at 2007 and 2008 because that's the sort of benchmark for a housing price crash. They wrote the stock down by 11% in 2008 and 2009, which doesn't sound too dramatic, even though volumes fell 40% or so. The stock value, the land and the housing half-built houses reduced 11%. And in terms of valuation, I think the shares got down to about £4 right at the bottom, and book value was about £8 a share. So you're buying at a 50% discount. Roland was buying at almost a 40% discount last year. So you could argue, okay, if things get really bad, if we have a repeat of 2008, the discount could get down to 50% again, but it may not happen. I think you have to look at book value. And also in 2008, the company had net debt going into the credit crunch. Now all the builders have got net cash, as far as I'm aware. So the balance sheets are already looking stronger, I think, if there is a difficult housing market. Plus, you've got the annual report saying, this is what we mentioned on the podcast, that the annual report is referring back to 2008, saying we're stress testing the accounts going back to 2008. Look what happened then. And so the management are aware of what can happen in a downturn, which gives some confidence to shareholders.
Yeah, I think in answer to your question, the land bank was booked at about 2.7 billion in the last accounts, which is about 2/3 of the book value, if memory serves me right. There is a big chunk of value tied up in land that maybe won't be realised at the valuations originally thought. But as Maynard says, the management or the chief executive was working there at the time in 2008. So they modelled their testing on what happened previously. And hopefully that's sufficient to prevent anything really painful happening to the equity.
House prices, the average Bellway house price in 2008, 2009 fell just 11%. We talk about
in some ways that would be what I was worried about, that it's not just that the house prices fall, it's the transaction levels fall. So that's why the revenue was much more steep.
That's killer. Mortgage funding dries up and the volumes. But if you look at a book value, you think, okay, this will all sell at some point to somebody, and you're buying it at a discount. It's just the size of the discount, I think. Assuming people are going to still buy houses.
I mean, from my perspective, I can see that mortgage approvals are down by about 1/3 the first quarter versus the first quarter of last year. And I think things are going to get worse before they get better. So I don't hate house builders perpetually, but I think there's going to be a better time to buy it.
I certainly agree on that. I'm fairly negative on house prices and particularly transaction volumes. You do have to think that the equity markets tend to look 6 months or further ahead. So I wonder whether the market has already priced in the mini budget and the rise in interest rates, whether we're seeing the effects of that now and in the future, that almost like the low has been in because the market's been looking forward and anticipating these things. I definitely agree with you on that, Bruce. I'm pretty negative on house prices and transactions, but balancing that, I'm thinking, is this the bottom for the equity markets in house builders? They're not necessarily correlated at the same time.
Yeah, the market's forward looking. I suspect, as you've said, Mark, I suspect when Roland was buying at 17 or 18 pounds, the market was expecting some sort of downturn. It's not yet happened, but I think in terms of house prices, I think we're in for a protracted period of stagnation. Let's probably muddle through it. But I think there's got to be a really big sort of market downturn to get a deeper discount than 40%, which I think Roland was buying at.
High inflation is good for housing transactions because, of course, everybody thinks that house prices have fallen apart from their own house, which has unique properties and means it's still at its peak valuation. Whereas if you have 10% inflation, okay, assuming wage inflation and that aspect of the economy is hotter as well, then it's very easy for somebody to put the house on the market, sit for a year, accept the asking price and forget that they're actually maybe 10% lower in terms of what they've actually accepted for the house. So that may help housing transactions as well.
So is there any point in the cycle or in the markets you would buy house builders, both Bruce and Mark? I mean, what needs to happen to Bellway or any house builder before you'd buy, if at all?
Historically, buying them in a recession, it's a bit like buying banks in a recession. If you can get the timing right, you make a lot of money. They're not long-term holds, but they're very cyclical stocks, and they're better to buy when they look expensive because there are no earnings, rather than when they look cheap and they have high dividend yields and everyone goes, oh, they're throwing off lots of cash. It's a highly cyclical sector, a bit like banks. That's why I'm a little bit nervous of they're on a discount to book value, therefore they must be cheap type arguments.
And I think you make a good point in terms of, as investors, we don't have to own every sector or every type of business. If your central assumption is that the relatively small drop in house prices, maybe a little bit drop in house volume, then something like, I don't know, Lloyd's Bank on a big tangible book value, whereas most of that value is residential lending or commercial property lending could be a better deal, I think. And that's in the back of the mind, or things like brick manufacturers look cheap, or double glazing manufacturers look cheap, and potentially not necessarily on the book value side, but on the earnings side, if you believe that house builders are still going to build houses, they're still going to want components and bricks and all the stuff that goes into the houses, I wonder whether there's better plays than the house builders themselves.
So, Roland, are you still happy, having heard comments from Bruce and Mark, are you still a happy Bellway shareholder?
Still happy, really. I think my original hypothesis is still pretty much as I thought, really. I think there's risks ahead over the next 6 to 12 months in the real economy, but I'm hoping that I paid a little enough for the shares and chose a business that has the ability to manage through that situation successfully. So yeah, I'm still happy, but I'm not rushing to buy any more right now, unless they get a bit cheaper.
Bruce and Mark, you seem reasonably negative. I think I agree with Mark. If I was a deep value investor, I would have just bought a basket of these shares back in October, not bothered to pick out a single one in particular. I think I'm a bit more bullish than Bruce and Mark on the housing sector. I'd look at a deep discount on book value as a buy sign, I think, if I was a deep value investor. Shall we move on to Luceco? Talk about Luceco, Mark, and why you bought the shares?
Yeah, so let me start with a question, which is, what would you pay for a company that's grown revenue 14% compound over the last decade, and during the same period, its net income has compounded at 27%, and the company has averaged a return on equity over that period of around 28%? I think if you just purely saw those metrics, that a lot of people would give a relatively high multiple to that sort of business. And of course, the business I'm talking about is Luceco, and it's a manufacturer of electrical and lighting accessories. You might have bought their electrical parts if you bought something from Screwfix or B&Q, or the big DIY place. You might have bought an extension lead that's branded as Masterplug, which is probably the most commercial retail-facing brand they have. It's grown organically and by acquisition since that time. It listed in 2016. So some of that is pre-IPO figures that I've quoted. And its last acquisition is in the EV charging space. So it's not just sitting still. It's a business that's looking to redeploy capital to invest that to grow. And I think this is a quality compounding share. I guess we'll see whether Maynard agrees on this one. I'm not always a fan of quality investing. I know kind of Maynard does it very well, but in my opinion, it's a good way to invest. It's just very hard. I think we all know some of the quality businesses out there. We all know companies that have got potential moat, potential high return on equity. And what one comes to mind is kind of Spyrex Sarco. The kind of engineering has a lot of engineering expertise and is hard to replicate. But you have to pay 30 times earnings to own this stock at the moment, and its EPS is growing at sort of 10%. So I struggle to see like kind of a stock you're going to generate higher than market averages. Whereas I think Luceco, as boring as it sounds, actually is one of these stocks that may be able to generate or compound at higher than average market rates, and you're only paying something like a 12 times FY24 multiple for it. And that's what attracts me, is this combination of strong history compounding and a low multiple. When I look at these sort of businesses, there's 4 things I look for. So the first is moat. I don't think Luceco has a particularly strong moat. Its gross margin is about 37%, but it's got a consistently high return on equity. So I think there's something there. There's operational excellence. So it designs and manufactures the majority of its components, either in the UK or in China. And it's just an operationally excellent company. And it's generating its moat by just being better than the competition in doing that. And this isn't a particularly strong moat, but I think those return on equity figures speak for themselves. The second factor I look for is runway. So you need a company that has room to scale. And my counter example here is Somero. Somero, in my opinion, is a great business, but has a fair bit of saturation in its market. If it's going to grow, it needs the construction industry to grow. Whereas I don't think Luceco does. I think there's plenty of opportunities for it to continue to take market share and also buy and build, add acquisitions on. The third factor I look for is operational leverage. Ideally, high gross margin. I don't think it has this here, and a low net margin. So it certainly has a reasonable gap between high and gross net margin. The reason is from the 100 Baggers book. If you've If you've read that, then it's one of the signs that as the business grows its revenue, if the admin costs stay the same, then you get this big operational leverage. And I think Luceco has this because you see that its net income has grown faster than its revenue. So I think that's a sign there's at least some operational leverage there. And also, I think it's fairly cheap at the moment. The forward earnings aren't amazing. It had this sort of backlog of customer inventory. So customers got a bit carried away into 2021, ordered a lot of stuff, and that stuff's gradually working its way through. And I think in the last trading statement, they said they're pretty confident that they're close to the end of that customer destocking. So therefore, like Bruce is saying, with things that are cyclical, you want to buy when the earnings are low. And I think there's a potential for this year's earnings to be the trough and you to see the company return to earnings growth. And finally, my bull point is that the CEO owns about, I think it's 18% from memory. And also all the other directors pretty much have been buying recently. So including, I think the CFO kicked off the buying about £1.08, and other directors have been buying even into strength. They haven't waited for a pullback. They've continued to buy. So no guarantee they know anything that we don't. In fact, they shouldn't be buying shares if they have inside information, but it does give a certain confidence that management are backing this opinion with their own money.
Bruce, your view on, is it a quality compounder? Is it a Buffett style company?
I don't think it's a quality compounder. I looked at this when the share price was around 45p and I nearly bought it. And that was a mistake because I should have bought it because it's gone up a lot. But when we say operational excellence, the trouble was that the reason why it got so low a couple of years ago before the pandemic was because their financial controls weren't working well and they didn't realize how much customers had overstocked. And they had a couple of profit warnings, I think. When you say compound annual growth rate of X and the net income rising by Y, that fails to identify the fact that it did blow up a couple of years after the IPO. I also don't think it's a great brand that who goes, oh, I really must have a Luceco LED light bulb. I just don't think that it's something that people pay a premium for. So for that reason, I don't really understand the high ROE, and that makes me a little bit nervous. Those are my thoughts.
Let me come back on that. I agree on the consumer facing side. I don't think there's a lot of brand equity in those things, but I think, for example, the LEDs they're not just necessarily producing LEDs that are, or LED light bulbs that are going to your retailer. They're doing industrial or citywide installations, and they're also taking on the design. So customers are coming to them and saying, we need this type of LED lighting for this application, and they're designing it and then manufacturing it. So there's a sort of design aspect to that. I agree in general, just producing LED lights is not a high moat business, but I think they do certainly capture a bit more of the value chain in that. Not a huge amount, but they definitely have design and manufacturing aspects that give them higher margins, I believe.
Roland, your view on Luceco? It does pay a dividend.
Yeah, it does actually. Funnily enough, it is a share that has appeared in my screens recently as well. And in some ways, I kind of have a fairly positive view on it, really. But I think there's a couple of things that would concern me, or that do concern me, that might discourage me. Looking at it at the moment, the wiring business, the wiring accessories business, and the portable power business, I think they're quite attractive and a good share of the market in the UK. This is really quite a UK-centric business, isn't it? It's about 80% of sales and 85% of profit, I think, last year, something like that. So one of the things that concerns me a bit is the group kind of expansion. And you talk about runway, but I wonder if attempts to go international in the way they have are not necessarily going to add to returns for shareholders all that much. Look, 4% of sales into the Americas last year. That was about £4.6 million, I think. Well, obviously, in a market of that size, that level of sales is a rounding error, and they must be competing against much larger and better known regional brands. So I wonder how cost effective that kind of expansion is, and especially as some of the projects are going to need to be regionalized, if you like. There's different electrical regulations and fittings and so on in international markets. So I suppose that's one concern. And more broadly with LEDs, the company has 3 brands in the UK with LED lighting, which I think have a market share of about a third collectively. That would seem you would give it some kind of competitive advantage maybe in the UK. It's a big share of the market, but operating margin last year was just 4% in that division. And looking at the acquisition, the DW Windsor acquisition, it seems to be quite a lumpy business in terms of sales and profits from year to year. So I wonder about the quality of the LED business, really, even with a decent share, and maybe about the wisdom of trying to expand so widely. I don't know what you think about that, Mark.
Yeah, I think they're all valid points. The thing that springs to mind is that a lot of people think that scale should give you higher operating margins. It's one of the predictions of Michael Porter's kind of 5 forces. Unfortunately, there's no empirical evidence that any part of Michael Porter's work actually has any predictive powers. There is no correlation between market share and operating margins for businesses across the economy.
Still on the margin, so you've got the wiring subsidiary, which looks the jewel in the crown, I think. So that's, I think, one of the subsidiaries in wiring is 80 years old, and the whole division's got 19% operating margin. So that's where the moat is, I guess. People are prepared to pay a premium for these wires. But LED lighting, as Roland said, is 4%. Portable power, which is the extension leads and electric vehicle chargers, that's 9%. So you think this has got a great business with wiring, but the other two businesses where they've been acquiring these other divisions, lighting and power, that's where it seems all the growth stats you've quoted is all through acquisitions of more lighting businesses, which are lower margin, don't seem as great as the wiring subsidiary, which is slower growing, but it seems to have more of a moat. I'm not convinced it's entirely a Buffett type business. It says it can return to a 15% operating margin, which sounds great, but it's always been about 11%. It was 11% last year, 11% before the pandemic. Forecasts are about 11%. So it's a bit average, well, I can tell. I mean, on terms of gross margins, I own shares in FW Thorpe, which is a lighting business, and it makes LED lighting, and it's got gross margins of 44%, and it's got a group margin of about 17%. So we can make decent money out of lighting. It's just the types of lights and who you sell them to. I'm not convinced about Luceco. I think it does a lot of retail, selling lights for retail. And that's where a lot of the sales growth has come from, buying up lighting and power businesses. I'm not sure of the record before the IPO, but I always look at post-IPO, see what they've done as a listed business. So I'm not entirely convinced it's a Buffett-style business. Go on, Mark.
Just to come back on that, FW Thorpe has, although probably a little bit more consistent, has a much lower return on equity over the period. Well, I'm looking at Stockopedia, so over the period Stockopedia has, and it's on a P of 20. So I agree, it's a reasonable business. There's something about Luceco that they're doing something better than FW Thorpe, even though it's got higher operating margins, and they're on 2/3 of the rating.
Yeah, I think on the ROE. For Thorpe's ROE has always been depressed because they've got this huge cash pile, which they've started to reinvest in overseas businesses, funnily enough. So the ROE has been depressed. It's about £70 million at one point, which is significant for a sort of 400 million pound business. Luceco's ROE, is that not down to debt? They've funded all their acquisitions by debt. So they've got a small equity base.
So on Stockopedia, so the average over kind of the last 5 years, return on capital employed is 24% for Luceco and is about 15% for FW Thorpe.
Also, FW Thorpe, you get the reliability of having lifted your dividend for each year for the last 20 years, plus a few specials as well. So you're paying up a little bit for that quality. And also, when I bought it at least 10 years ago at 8 times earnings, I'm not buying it now at 20 plus.
But then the dividend yield is double on Luceco, and of course, dividend growth is a terrible strategy.
It reflects the operational consistency of the business. You've got some sort of track record to judge and think, okay, the dividend's up every year for the last 20 years. Maybe there's something to this business. There is a moat, perhaps.
I think I'd agree if it was paying a 4% dividend, but not at a 1.7% dividend. But yeah, it's very easy to increase your dividend every year if you only have a small payout ratio, and therefore you can, the ups and downs of the market.
Do you think having one location in China for production, if that's a risk, and having a big, large customer as well?
There's definitely a China risk. It affects quite a few companies like UPGS and other companies. The way China having all your manufacturing, or a significant portion of manufacturing there, they talk about, or Luceco talks about, diversifying manufacturing. So one of their next acquisitions that they'd be looking for would come with sales, but also manufacturing outside of China, potentially somewhere like Thailand, that they can then use their operational excellence from their owned China facility and put that into both new products and into a new location as well, and it gives that robustness. But I don't think you're ever going to remove that risk here, even if they do that successfully. And acquisitions always have risks involved with them. If they do that successfully, you're still going to have a China risk. I agree on that. It's not for people who don't like to touch China.
What about recent trading? Because their last statement talked about for-like sales down 9% and remaining conscious of macroeconomic uncertainties, which doesn't sound great.
But also they say the market took that update pretty positively. They also paid down a massive amount of debt. They've increased prices. Those price increases are working through the business now, and they say that that is now fully offset and that they're seeing those benefits in this year, and that they believe the customer destocking is almost over as well. I agree that the absolute numbers were not great, but the outlook was very positive, in my opinion, on that one. Yeah, you could choose to highlight either, I think, in that statement.
Although I wonder a bit if this visibility issue, it could be a problem again. I know Bruce mentioned that profit warnings in the past before the pandemic due to unexpected destocking. And obviously what's happening now is destocking, although maybe coming out of a more exceptional set of circumstances. But from what I understand, roughly half the revenue comes from big distributors who buy their stock directly from China free on board. So they tend to hold a lot of inventory for quite a long period. And so I imagine Luceco could be caught out again by changing stock levels in the future, because they won't necessarily have that insight into their customers' inventory levels that they would if they were supplying more directly. Again, about the lack of consistency maybe going forwards.
Yes, that side of things will always have lower visibility. I know investors love stability. They love something that is consistently going up monotonically, even if it's a very low rate of increase. But personally, I'd be very happy to live with that volatility for the higher overall growth rates. So I don't think there's a lot of obsolescence in there. You're not seeing big stock write-offs. What you're seeing is slower ordering while that works its way through the business. And potentially one of the strengths is that this is not commodity, but the item, everyday use items, stuff that is always used on projects, and anything that's bespoke that they've designed for a customer is ordered in the volumes the customer wants. And then you've got this more general manufacturing that goes through distributors, but it's the sort of stuff that's always going to get used eventually. So yes, if you don't like earnings volatility, this isn't the stock for you. But personally, I don't mind earnings volatility if the overall trend is positive. In fact, it tends to lead to investors getting carried away in periods of positive and over pessimistic in periods of negative trading. And like I say, I'm not a great quality investor. So if this gets to £5 or something in the next couple of years, I'm probably not hoping it's going to be a Buffett compounder over the next 20 years. I'm going to be like, it's now on a P of 30 and it's trading really well, I'm gone, sort of thing. Yeah. Again, partly my style rather than fundamentals of the company on that one.
Bruce, can you see this company ever trading on a PE of 30?
No, but I'd buy it again if it got down to 45p.
Okay, Roland, is this ever going to be in your website portfolio?
I wouldn't necessarily rule it out, but I think it's unlikely. And for me, the trade-off between the growth ambitions and the buy and build model, to me, they carry an extra element of risk, which could work out very well as an investment, but it's not really what I'm looking for. I think the business could maybe generate higher returns for shareholders and more consistent returns by maybe restricting its scope slightly more and focusing on the more profitable advantaged areas of the business. So it's probably not quite for me, but I can see the investment case here, and the valuation certainly doesn't look outrageous at all.
I'd be interested if they sold the lighting division, got rid of the power division, just focused on wiring. It'd be a much better business. And you've got, as you said, Mark, you said the chief executive owns a lot of stock. So that's interesting as well. Okay, so Superdry. Let's move on to Superdry. Bruce, this was something you mentioned on a Value Trap podcast a few months ago. So why do you own shares in Superdry?
So I have a high conviction that the share price is wrong. This could be real egg on my face, I feel, because I can see this could go wrong. Or hopefully there's a lot of upside, but if there isn't, probably 75p is not the correct price if trading continues to deteriorate. Now, I bought it second half of last year because it looked like they'd turned the corner and the turnaround was working. And then they had another profit warning at the start of this year. And what seems to be doing the damage is wholesale, which is about 37% of sales. Struggled in the second half of last year, but also was down 57% in the 9 weeks to Christmas. Surprisingly, the rest of the business is doing reasonably well. Retail and e-commerce, which together are about 60%, doing reasonably well, but something's gone wrong in the wholesale division, and it's not particularly clear from the management communications what's gone wrong. The latest thing that's happened is that they said that they're going to make a disposal and sell their Asian Pacific business for 34 million net of costs. Now, that's a remarkable valuation because that implies, I think, 7 million of sales. So, about 5 times sales, whereas the business Superdry group as a whole is trading on 0.1 times sales. It's a real distressed valuation. It's down 95%. There's no reason to suggest it can't fall 100%, but this looks like it's a deep value. But if they turn it around, I think it's quite an interesting brand. I think the chief executive co-founder understands brand. The previous management who took over from him didn't really understand it. And I think if he can turn this around, then there's a lot of upside. I do worry, though, that he might have taken on more than he might have bitten off more than he can chew. And we haven't even gone into a recession yet. And the retailers are all really struggling. So this isn't just Superdry, but ASOS and Boohoo and all these other guys are struggling as well. Dr. Martens we saw last week, also pretty discouraging update.
So in the last accounts, there was going concern worries, and they raised £11 million from shareholders. And you've got this £34 million from this IP sale. So is the balance sheet now on an even keel? Is the worst over in terms of the balance sheet?
I think the 12 million wasn't enough. And I was expecting them to do a rights issue because I felt like a placing wasn't going to be enough. And instead, what they've done is they've said they're going to sell their Asian Pacific business, which if that deal completes, then yeah, I feel like that 50 million in the bank, that solves a lot of their problems and we'll see them through. I wouldn't say we're quite home and dry, but that would considerably be a positive catalyst, a considerable positive catalyst for the stock.
Is there some doubt as to whether that deal will complete? Because it seems a remarkable valuation for what it is. It's sales are 7 million and they're paying £34 million for it from a distressed seller, effectively.
Yeah, absolutely. I don't really understand what's going on there. I feel like maybe I'm missing something because that does seem a remarkable price for a business when you have a distressed seller.
The buyer is a quoted Korean company. So there is some sort of validation that the deal will complete because of it's quoted, but yeah, I don't know. Mark, is this a value share? Is this on your radar at all?
I guess I just didn't find what Bruce said particularly convincing. It's like sort of that the outlook's terrible. They've got all this debt. I get that potentially this is the equity is more like an option here. And actually, if they return to sort of 80p of trading, or was it 80p of EPS somewhere in sort of 2017, 2018, then being on a P of 8, being on a price of 80 is clearly wrong. But equally, on the numbers at the moment, they're expecting, brokers expecting a sort of 2024 earnings of about 6p and a P of 14. And I notice their working capital has really fallen off as well, which suggests they're maybe struggling to pay suppliers or not. Maybe they've just got better working capital management. But there's a lot there that just makes me think, yes, this is option value, but it's still an 80 million market cap. So are you paying too much for the option? I put it in the too hard category, I think, particularly with the macro background. You look at something like Quiz that just has loads of cash, is potentially on a 4p of 6. Okay, it's a much smaller company, but I just wonder whether there's better optionality plays for retail at the moment. So yeah, a too hard for me, really. I'm not seeing a clear picture. They return to this big profitability and that they are clearly underpriced.
One of the things I think is that we will see considerable uncertainty reduction over the next few months in terms of this deal completing or not, but also just an update on trading, if things have continued to deteriorate or whether actually they've stabilized now. At the moment, I think it's a buy because I think the risk reward makes sense. But also if we see continued deterioration, if we see credit insurance removed from suppliers, or we see insider selling or anything like that, then that would be a reason to get out, I think.
I agree this kind of 34 million is a nice number to have, but also it was a total a net debt of 225 million. Is that including IFRS 16?
Yeah, that includes all the leases. I think they should be pressed,
right.
Yeah, which is another issue.
Yes, yeah. And have they managed to put leases onto, because a lot of companies are going for like revenue leases now, with retail stores, so they get a proportion of revenue rather than an absolute amount. Do you know if they managed to move to those?
I've listened into a couple of calls and I don't think anyone's asked that. Well, one of the things I would say is that actually the stores aren't the problem. They're seeing revenue growing. The problem seems to be in the wholesale. So actually, this isn't really a story about French Connection was a few years ago of, switching over to closing shops that had unprofitable leases on it. Actually, they're seeing reasonably good footfall going through the shops, but it's difficult to work out why wholesale has been so weak.
They do have some, I checked the small print of the leases, and they do have some turnover related stores.
Okay.
But there is a large obligation for the leases. And you look at the right of use asset, it's a lot lower than the lease obligations, which suggests they're on the hook. If they were to take out those leases today, they'd be paying a lot less than they are obliged to pay. So, Roland, this does not pay a dividend. I suspect it doesn't feature on your dividend radar.
No. I think in terms of the risk-reward ratio, for me, it doesn't add up. I can see clearly that the financial opportunity, it's an option. It could be a great success. Even if the turnaround is just halfway successful, it could be a good investment. But I suppose looking at it, there's a few things really that worry me. Financially, there's the track record of multiple comments about poor financial controls, the expensive Bantry Bay debt facility. I wonder if the £34 million, most of that might be absorbed just by repaying what's been drawn under there. And then I suppose leaving the financial stuff to one side, I wonder if what gives you the confidence that the brand can really have its day in the sun again. Some of these mid-market brands do tend to come and go. If people lose faith, as it were, or if the market changes, it can be hard to bring them back to growth. Are you still very confident in the strength of the brand?
Well, I think the brand's always been a bit of a joke, to be honest, the sort of pro-Japanese slogans. But in some ways, I feel like actually now people wear it as an ironic thing. Yeah, I mean, I know this isn't a particularly strong buy signal, but the other thing to be aware of is that in the UK, everyone knows the brand. But I think internationally, you mention it to people in Germany, and there are Superdry stores in Germany, but people don't know who Julian Dunkerton is, don't know who Superdry is, and they just think it's another shop. So I feel like we have a slightly UK-centric view of the brand, and I feel like people have been saying it's a Thai brand for 10 years, almost since it IPO'd, actually. So that doesn't bother me so much, but I can see that the turnaround it's going to be difficult.
The financial controls and the audit report aren't great. You've got to admit that.
Yeah, that is also true. I think what we're seeing here, though, it's rather than it's a fraud or anything, it's because it's a founder-led business. And the founder goes around and he's very interested in fashion and marketing and selling and presenting. Since it's IPO'd, they've had a problem with financial controls of various finance directors getting into trouble over different issues. Famously, about 10 years ago, one of the finance directors got a minus sign instead of a plus sign in the spreadsheet, and they had to have a profit warning because of that. That's always been the case with Superdry, but I think you can be confident. It's just the controls. The founder owns 26% of the company, and he's been buying recently as well. It's not a fraud in the sense that we would traditionally call companies a fraud.
Julian Dunkerton, he has sold a lot of shares though, hasn't he? He still owns 25%, as you say, but he sold a chunk in 2018, 2017, 2016. I calculate from SharePad, £72 million he's sold. So even if it does go to zero, he's not out of pocket. So that's...
Yeah, I mean, he sold in the IPO, but the shares did very well afterwards for about 5 or 6 years. When he stepped down, he sold a lot. And then when he saw things were going wrong, he stepped back in and he's put his money where his mouth is.
If there's a history of lax financial controls, is he the right man to... I suppose he's the only man to lead it because he's the founder. But
what I would say is I think you need a strong finance director. And as far as I can tell, I mean, it's very difficult to tell from the outside from just management presentations, but as far as I can tell, they seem to have got someone he comes across as competent. Put it this way.
He's ex-Marks and Spencer. I think he was in charge of the clothing and home division. So a pretty sizable part of Marks and Spencer. So you'd like to think he knows what he's doing.
Do you think they have the money to spend on improving those financial controls? Because obviously it's not a case of somebody checking for minuses in the spreadsheet. It's ERP systems and that kind of thing, but that takes twice as long and twice as much as you ever think it's going to take.
I think it's one of these things that when revenue falls 30%, then suddenly everything's a problem. And these businesses it'd be great to be able to fix your roof when the sun is shining. Unfortunately, when businesses go wrong, it's normally not just one, things go wrong together. So yeah, this has happened at the worst possible time for them, but I can see it going wrong, but I'm still optimistic that they can pull through.
The worry I have is you can't trust the numbers. So in the last annual report, the auditor, who's now resigned, said that we have identified the deterioration of controls. So they're getting worse, even though the deficiencies have been highlighted in the last 3 annual reports. They're getting worse. So a significant number of misstatements have been identified during the FY22 audit that in aggregate were material. You think, no wonder these shares are 80 pence and the market cap is £79 million and sales are 600 million. I mean, in the webinar, the latest webinar, they were talking about, or Julian Dunkerton was talking about getting back to an EBITDA margin of about 10% or something like that. So you think, wow, 60 million EBITDA, market cap of 80 million or so, really cheap. Are they going to get back to any sort of margin? You look at the recent history, it's been profit warning after profit warning, and the auditors can't add up the numbers, and the Deloitte have given up, they've resigned.
Yeah, absolutely. I'm not saying that investors should YOLO into their entire pension into this, but in terms of a risk reward as part of a portfolio, distress valuation, I feel like this could work. And if it doesn't, you can all laugh at me.
I think if you had 20 Superdrys, one of them will 100 bag and the others may all be down to zero.
I think that the brand does have value. It gets a bit passé because it's middle-aged men like us buying it, but also we potentially have the finances to buy a 50 quid hoodie or whatever it is. And then you are backing the founder to turn this around, aren't you? So it's got a couple of positives in there as a turnaround stock. But I guess personally, I just struggle to value that option. What are those two things worth? It's hard for me to say.
You don't sound convinced, Mark. Roland, I don't think you were convinced.
I'm not convinced about the balance of risk and reward, not for me at any rate. I can see the possibilities.
Are you still convinced, Bruce, after these comments?
So, yeah, absolutely. I feel like I have a high conviction idea that the share price is wrong. It's either going to be a lot higher or a lot lower. And the way to play this is to look at the news flow. And if things deteriorate, then to get out. If things are improving, then to hold on for the ride as the founder takes it back to a 10% EBITDA margin.
I think you may be on your own with this one.
So surely you need straddles or strangles or whatever they are. Something that pays out if the share price is significantly lower or significantly higher and doesn't pay out if it's in the middle.
Do you know what the Superdry Japanese text stands for, what it translates to in English?
I feel like you're going to tell me.
I've checked, and a Japanese blogger has called it gibberish. So on the Superdry logo, you have the Japanese characters, and it translates to "be sure to dehydrate to the utmost extent." So that is the Japanese.
Yeah, I feel like they
super dry,
into other languages. I mean, I always thought the Georgian script looks very cool. So maybe they should think about some slogans in Georgian gibberish as well.
Other translations from their T-shirts: car lubrication, extreme petroleum, sun class company, which I think is a typing error. I think it should be sunglasses. And the best one is horse-drawn carriage for business use. that was on a T-shirt for music records.
I'd say of this 10 bags, then Bruce should get a tattoo of one of these phrases on somewhere on him.
Yes,
should be his penance.
Yeah, we'll look forward to Superdry 10 bagging.
Absolutely.
We all picked out some good points of bull and bear point as a reasonable amount of back and forth of different things as well. If we had a general question of how many stocks do you own, and we can have a bit of a debate over how concentrated we are, that sort of thing. Or I guess they could request a share and we could look into it. So yeah, if people ask general portfolio management strategy questions, I think that'd be a good thing.
What the number of shares we should each hold?
Yeah.
I'll start. Buffett says you should concentrate on your best ideas. So why put money into your 30th best idea when you've got 5 really good ideas, and you should concentrate on that? So that's one reason. And the other reason is, the investor I am, I like to look at details. And I can't look in 30 shares in detail. So I can only look at 11, which is what I have at the moment. So that's why I run a concentrated portfolio. But I think Mark runs a more diversified. Roland has, I think, 20, which is quite diversified for me. And I don't know anything about Bruce.
I started off concentrated, then I discovered that my worst ideas, so my low conviction ideas, were doing better than my high conviction ideas, partly because it was stuff that was kind of option value and it worked really well. I own about 30 shares now, but yeah, I just look back at my impacts investment and just think I'm a complete idiot, because when the shares were 40p in 2016, it should have been a high conviction idea and it wasn't.
Mark?
I think at the moment I hold about 25. For me, it varies between about kind of 15 to 30. I know what you say, Maynard, in terms of there's only so much research you can do, but I also think there's those kind of unknown unknowns that take you by surprise, that if I get down to holding, say, 10 shares, at maybe my highest conviction ones then need to be maybe sort of 20% of the portfolio, my lowest convictions need to be 5%, and then every single share on the market could go to zero tomorrow without you having chance to sell. You know, you have to have that mindset as an equity investor. And when I get carried away with a stock, I know something's great value, but I try and limit the amount I have. And I think at the moment, you get two types of markets. One is like a sniper market. There's very small pockets of value, whatever you define value to be for you. And you need to be really precise. Okay, that's the stock for me. And then some markets are shotgun markets. It's like outflows. So much stuff looks cheap. I don't know whether a Somero is going to outperform a Luceco or a Superdry is going to outperform Quiz. I don't know. So in this sort of market, I'm much more tending to go for more superficially cheap shares and reduce my idiosyncratic risk by doing that. But potentially I'm exposing myself to other risks.
Roland?
Yeah, I think, as you said, I've got about 20 shares in my portfolio, and I think there is a couple of reasons really that I've ended up in that position. Partly because I want the portfolio as a whole to generate fairly reliable and hopefully increasing income. And partly because I think over the years I've found that while I've generally been happy with most of my selections, I've not always been very good at selecting the best ideas from the slightly less good ideas. So I'm not sure I'd be comfortable narrowing down the portfolio, say, to 10 or fewer shares. I wouldn't have the confidence in my own ability to identify the best ones. But having said that, I suppose I wouldn't want the portfolio to get any bigger, and I can see that it might get slightly smaller, say somewhere between 15 and 20 over time, as I gain a higher level of confidence in shares that I've owned. And again, to the other point is that if I have 20 positions, say roughly equally sized for the sake of argument, although they're not, if one of those halves, I've only lost maybe 2.5% from the value of the portfolio. So that's not the kind of thing that would keep me awake at night too much, or the kind of risk that would keep me awake at night too much. So I'm trying to find a balance between identifying good ideas, but not relying completely on my finer judgment of exactly which are the best ideas.
I think what works for you is right for you. If you look at Peter Lynch, American fund manager, he had thousands of stocks in his portfolio or something, and he crushed the market during the 1980s. So it works for him, having loads of stocks.
I wonder whether there's a factor, so I've written about this before, is whether we're overconfident. So obviously one of the signs of overconfidence is that you underestimate the risks of any individual stock, you underestimate the risks of the market, you end up too concentrated. And I know I'm overconfident. I know I think, oh yeah, this share's bound to be taken over. It's got so much good qualities, and then everything else gets taken over and this is left on its own. There's loads of things like that. I think a turnaround is going to happen and it doesn't. There's so many things I'm overconfident about. What do you guys feel about that? Is that something you consider, or?
Yeah, yes, I do consider that. Because if you are a stock picker, you are by definition overconfident, because you're saying, I know more than the market. I'm buying this stock. Regardless of what it is, I know more than the market. So whether you have 20 individual picks or 10 or 50 or whatever, you're inherently being overconfident. But yes, I do think, okay, I've got 15% in one position. Am I overconfident? Probably. But you bet big when your odds are in your favor. That's where all the most investment gurus, all the rich people who've done it, been there and done it, that's their advice. Not many people have become really rich in a tracker.
The successful ones, the ones that survive.
There's the survivorship bias, of course, because there are millions of private investors who've hit zero, picking their own shares and lost money. But yeah, it's a survivorship bias because all the rich people have bet on one thing or invested in one company, got rich on that just one stock.
And I think you should also have a different view depending on your circumstances. So this is something else I think people forget is potentially the older you get and the less chance you have to live through volatility, potentially the more diversified you should be. If you don't have other income coming in, you should maybe be a bit more diversified. Whereas if you've got secure income from a job or a spouse, you can afford to be a bit more, and lots of other things like that. How much research you do, clearly. So Maynard does a lot of research, should be more concentrated than somebody who uses a quant fund that uses a series of metrics across an entire asset class. So I think that's what people get wrong as well. They assume I'm always a 5 stock or a 50 stock portfolio, and that should vary over time depending on your circumstances as well as your style and your personality.
You can only find the number of stocks is right for you over time. And it's like the sleep test where you think, if you wake up in the night and you're thinking, I've got too few stocks, I'm heavily concentrated. If that's worrying you, you need more stocks, you need to diversify. But you're right, Mark, it's dependent on your own circumstances, your own experience. And if they all go to zero, can you survive financially? If so, yes, then just have a handful of stocks, maybe.
And potentially other mistake people make is they have a very diversified oil and gas portfolio or a very diversified banking portfolio. It's understanding those risks and how they correlated in your portfolio as well, I think.
The other thing that's worth thinking about is how much cash you hold. So I used to be very concentrated, but held a lot of cash as well, ready to deploy into stuff. So I don't know Mark doesn't tend to hold much cash, but
yeah, zero is my aim of my portfolio. Yeah.
I don't tend to hold a huge amount of cash, although I do have more than usual at the moment. But yeah, I tend to aim to be mostly fully invested as a general rule, not least because it's not earning any income if it's sitting in cash. Maybe 1%, I think now I'm getting.
What's your percentage of biggest holdings? I think mine's about 15%. My largest holding is 15%, which some would say is far too high.
My top 5 was 70%. I haven't looked at it recently, but my top 5 would probably be about 70% of my portfolio of 30 stocks.
I'm about the same as you, a very high conviction position, which I think has a significant tailwind behind it at this time. But also I am aware that I'm potentially overexposed to that particular stock. So I should be eating my own cooking on this one. But
so you've been tempted to the dark side.
The dark side, yeah. I'd say I'm overconfident.
Or the share hasn't just gone up, so it's dominated you?
Partly. There's an interesting thing where people say run your winners, and if you do I think Bruce and I talked about this, if you look at all the hedge funds and people, their portfolios, and you can do a really good replication strategy where you take the top 10 from all these hedge funds, you buy the top 10 and you get a portfolio that outperforms the market, with the one caveat is you don't buy the biggest holding in each one. And the reason is it's not their highest conviction position because it's not their largest holding because it's their highest conviction position. It's just the one that's gone up most recently and they haven't sold back. So I believe you should run your winners, but the evidence is that many professional investors run their winners too far. This is partially that, but it's just the level of undervaluation I see and the positive outlook for the stock. Yeah.
Roland, how's your portfolio? Is it Bellway your largest position?
No, it's not. But my largest position's probably about 7% at the moment. So it has been higher in the past, but it's come down a little bit. I probably wouldn't intend to go much over 10%, even with something that I was quite happy with.
When I started, I had quite a concentrated portfolio, and Bank of Georgia was, I think, 40 or 50% of my portfolio.
The largest position I've held was London Stock Exchange. This was 2002, 2003. This has gone up to 30% or something like that when I was buying. And I thought, there's one time I thought, this is so cheap. This is so cheap. I should put all my money into London Stock Exchange. This is about 2004. So it had recovered from the dot-com crash, but it was priced at about 12 to 13 times earnings. It's a monopoly business. And even though the market had recovered, the LSE share price hadn't. Huge margins, cash rich. And I thought I should put all my money into this. It's so cheap. But I kept it at 30% and it's 5 bags various takeover approaches. I could be in Barbados now if I put 100%, but I didn't. I just kept it. And and the worst thing is I was trimming it. I was buying at 3, got up to 12, trimming it.
Was it 70 now?
Yeah. Well, I sold the whole thing in 2007, sold the whole out. But now it's only got up to 90. So if I put the whole thing in and kept it all, yes. But
I don't think there's anything wrong with top slicing in that situation. It's like the problem is that the volatility on these things kill you as well. Is you don't top slice, you hold this thing, you put 30% in, it gets to 60, 70% of your portfolio, and then something doesn't quite go right and it drops 20% on a temporary profit warning, you panic because it's like you can't cope with that kind of loss volatility.
It's all right looking at hindsight. You look at the chart and think, oh, if only I'd held that for 20 years, I could have had a 30 bagger or 40 bagger or something like that. But 2007, 2008, LSE was what? I can't remember, £12, got down to £5 or something like that. I can't remember the figures, but it's a huge drop. And having all your portfolio in that one share dropping, or a significant part in that one share just dropping, mental pressure on you would have been significant. That's the issue.
The way to deal with that is to go into business with an alcoholic and you'll never worry about a 50%.
Put your money into a bar, is that right? Yeah, but we can all look back at charts and think, oh yeah, I would have held on. It's only a blip, but at the time you think I'm down 60% from the top, you're thinking, oh, I should have sold.
The best strategy is the one you can stick with through thick and thin.
Well, that's it for this time. Thanks for listening to the Investors Roundtable. If you enjoyed the podcast, please let us know by liking, subscribing, or even leaving a review. Until next time, thank you and goodbye.